AI does not really live in the cloud. That phrase sounds strange because everyone talks about cloud computing, AI models, and digital transformation. But behind every AI model, there is something very physical: servers, power, cooling, fiber, land, buildings, and a lot of real estate. That is where data center REITs become interesting. While many investors are trying to pick the next AI software winner or the next chip stock, data center REITs are focused on the physical infrastructure that AI needs to run. Names like Equinix and Digital Realty are not just real estate companies. They are part of the infrastructure layer behind cloud, enterprise workloads, hyperscale computing, and AI demand. So the question is simple. Are data center REITs the best way to invest in the AI boom of 2026? The answer is not automatic. AI may be digital, but the infrastructure is physical, and physical infrastructure still has costs, risks, debt, capex, and valuation. Data center REITs are real estate investment trusts that own and operate specialized facilities for critical digital infrastructure. These buildings are not normal offices. They are designed to house servers, networking equipment, storage systems, and high-density computing infrastructure. The customers can include cloud providers, enterprises, AI companies, telecom companies, financial services firms, and content platforms. The business can include colocation, hyperscale capacity, interconnection, power and cooling services, physical security, and long-term leasing. For beginners, the simple explanation is this: a data center REIT rents the physical backbone of the digital economy. It does not usually create the AI model. It does not usually make the chip. It does not usually sell the cloud software. Instead, it owns and operates the real estate and infrastructure where that digital activity happens. Data center REITs rent the physical backbone of the digital economy. And the reason this matters in 2026 is because AI is increasing the need for that backbone. AI is extremely infrastructure hungry. Large AI workloads need GPUs, they need servers, they need huge amounts of electricity, they need cooling, they need fiber connections, they need low latency, and they need scalable capacity. This is true for AI model training. It is also true for inference, where models are actually used by businesses, consumers, software platforms, and enterprise applications. As AI adoption grows, more cloud providers, hyperscalers, enterprises, and software companies need places to run these workloads. That demand does not appear out of nowhere. It has to land somewhere. It has to connect to power. It has to be cooled. It has to be secured, and it has to be connected to networks. That is why data centers are so important to the AI story. Every AI model needs somewhere to run, but investors do not only need to understand the demand, they also need to understand why data center REITs may be a different way to invest in AI. Most investors think about AI investing through chip stocks, software companies, cloud providers, or big tech. And those can be powerful investments, but they also create a difficult question. Which company actually wins? Which chip company keeps pricing power? Which software company monetizes AI best? Which cloud provider captures the most demand? Which valuation is already too high? Data center REITs offer a different angle. Instead of betting on only one AI winner, data center REITs rent space to the AI ecosystem. And to understand that thesis, we need to look at the two biggest names investors usually search for: EQIX and DLR. The two central names in data center REITs are Equinix, ticker EQIX, and Digital Realty, ticker DLR. They are both data center REITs, but they are not identical. Equinix is more focused on interconnection, colocation, global platform strength, and a premium ecosystem of customers and network connections. DLR is more focused on hyperscale capacity, cloud and enterprise demand, AI workloads, and large-scale global data center infrastructure. That difference matters. EQIX can be thought of as more interconnection heavy. DLR can be thought of as more hyperscale capacity heavy. Now let's look at how these businesses actually generate revenue. Data center REITs can make money in several ways. They can rent colocation space, they can sign hyperscale leases, they can charge for power usage, they can generate revenue from interconnection, they can provide managed services, and they can benefit from renewals when customers continue using capacity. But the rent is only part of the story. The economics are driven by power, capacity, connectivity, utilization, renewal spreads, backlog, and capex. For a normal apartment REIT, investors might focus heavily on rent and occupancy. For data center REITs, investors still care about rent and utilization, but they also need to understand infrastructure constraints. How much power is available? How much capacity can be delivered? How long does it take for signed leases to begin? How much capital is needed before cash flow appears? That is why metrics like revenue, AFFO, core FFO, leasing, backlog, churn, utilization, and development pipeline matter. The rent is only part of the story. Power, capacity, and connectivity drive the economics, and recent numbers show that the demand side is very real. The first quarter of 2026 showed real demand signals in the data center REIT space. Equinix reported revenue of $2.44 billion and raised its full-year outlook. Digital Realty reported a major backlog of signed leases that had not started. That backlog was $1.8 billion in annualized GAAP base rent at 100% share, and Digital Realty's share of that backlog was $1.0 billion. The lease lag was 19 months. That detail is important. It means demand can be signed today, but revenue may show up later. This is the key difference between excitement and cash flow. A company can announce demand, it can sign leases, it can build capacity, but investors still need to ask when those contracts convert into revenue, AFFO, and core FFO. Demand is real. The question is how much of it becomes profitable cash flow, and one of the biggest factors deciding that is power. The biggest bottleneck in data centers right now is power. AI workloads are increasing the energy density of data centers. More computing power means more electricity. More electricity means more heat. More heat means more cooling. And more cooling means more infrastructure. This creates a problem. Data centers are not only competing for land, they are competing for grid capacity. A site can look attractive on paper, but if it cannot get enough power, it may not be useful for the next wave of AI demand. This is why power availability can decide which companies grow faster. It can also decide which regions become more attractive for new projects. And it can delay development if utilities, permitting, grid upgrades, or local infrastructure cannot keep up. In the AI boom, power is not a utility detail. Power is the product constraint. And that leads directly into the first major risk: heavy capex and delayed returns. The first major risk is heavy capex. Data centers are expensive. Companies may need land, construction, power infrastructure, cooling systems, server-ready capacity, fiber connections, and years of development work before a project fully stabilizes. That means the timing can be tricky. AI demand can show up quickly, but data center returns are not instant. A lease might be signed today. The facility may still need build-out. Power delivery may take time. The customer may move in later, and the cash flow may only fully appear after the asset is delivered and stabilized. This is why investors should not treat data center REITs like pure AI hype stocks. They are real estate businesses. They have real construction timelines, real funding needs, real execution risk, and real return hurdles. AI demand can be immediate, but data center returns are not instant. And because the projects are expensive, the next major risk is funding. The second major risk is funding the boom. Data center REITs need a lot of capital to grow. They may use debt. They may issue equity. They may form joint ventures. They may sell assets. And they may recycle capital into new projects. That is normal for REITs, but it means data center REITs still live under REIT math. Interest rates matter. cap rates matter, development spreads matter, cost of capital matters, FFO and AFFO matter, and valuation matters. Even if AI demand is strong, a REIT can still create poor returns if it funds growth badly, overpays for assets, or develops projects at unattractive spreads. This is why the capital structure is not a boring footnote. It is central to the investment case. Data center REITs may ride AI demand, but they still live under REIT math. And there is one more risk that many investors underestimate: the power of big customers. The third major risk is customer bargaining power. The biggest customers in data centers can be massive cloud providers, hyperscalers, AI infrastructure players, and large enterprises. These customers bring huge demand, but they also bring huge negotiating power. Large customers may want customized capacity. They may negotiate hard on price. They may demand specific power density, cooling design, location, security, and contract terms. And when contracts are very large, customer concentration can become more important. So investors should not assume that massive demand automatically creates unlimited margins. Big customers can help fill capacity, but they can also pressure economics. That is especially important in hyperscale deals, where size can be huge but pricing and returns need careful analysis. Big customers bring big demand, but also big bargaining power. And this is exactly why data center REITs need to be analyzed carefully, not just bought because AI is popular. This is the kind of AI infrastructure and REIT analysis we focus on at Boring Money Wins. Not hype, not panic, not pretending that every AI-related asset is automatically a great investment, and not ignoring the real estate math behind the story. Data center REITs can be exciting because they connect AI demand with physical infrastructure. But investors still need to analyze AFFO, core FFO, CapEx, power, debt, funding, customer concentration, and valuation. If this kind of practical investing breakdown is useful, hit the like button and subscribe to the channel. It helps the channel grow and it tells YouTube to show more no-hype investing content to people who want clear analysis without the noise. Now that we understand the opportunity and the risks, let's turn this into a practical investor framework. Who may actually like data center REITs? Data center REITs may appeal to investors who want exposure to AI infrastructure without trying to pick only one AI software winner or one chip stock. They may also fit investors who like real estate cash flow, but want a REIT sector with stronger growth drivers than traditional defensive real estate. This can be interesting for long-term investors who understand that AI demand may support multi-year infrastructure needs, but the investor has to be comfortable with the trade-off. This is not the same as buying a conservative apartment REIT or a slow-moving triple-net lease REIT. Data center REITs can be more growth-oriented, more capital-intensive, and more sensitive to valuation. They may fit investors who understand AFFO, FFO, CapEx, development pipelines, and balance sheet risk. Data center REITs may fit investors who want AI exposure with real estate cash flow, but they are not right for everyone. Some investors should be careful. Some investors should be careful with data center REITs. If you're buying only because of the AI narrative, that is dangerous. If you ignore valuation, you may overpay for a strong story. If you do not understand CapEx, you may underestimate how expensive growth can be. If you expect data center REITs to behave like defensive REITs, you may be surprised by volatility. And if you ignore power risk, you may miss one of the biggest constraints in the industry. And if you ignore funding risk, you may miss how much capital these businesses need to grow. The AI boom can be real, and the investment can still be risky. Both things can be true. AI growth does not automatically mean safe REIT returns. So before buying DLR, EQIX, or any data center REIT, investors should ask whether the cash flow, growth, balance sheet, and valuation actually support the price. Now we can bring everything together. So are data center REITs the best ways to invest in the AI boom of 2026? They may be one of the most practical ways. AI needs physical infrastructure. It needs buildings, it needs power, it needs cooling, it needs fiber, it needs capacity. And companies like Equinix and Digital Realty are central names in that infrastructure layer. But the balanced answer is not simply buy the AI REITs. The better answer is this. Data center REITs can be a real way to invest in AI infrastructure, but investors have to analyze them as real estate cash flow businesses, not hype stocks. Power matters, CapEx matters, funding matters, customer bargaining power matters, execution matters, and valuation matters. The best AI investment may not be the flashiest one. It may be the infrastructure that survives. That is the boring answer. And boring money usually wins because boring money usually survives.